The final week of June 2026 marked a significant fracture in the pricing models that governed global markets for over a decade. During that 5-day window, AI infrastructure companies reported record revenue growth. Under normal conditions, this would ignite a broad market rally. Instead, it triggered a calculated liquidity drain. This aggressive exit was temporarily masked on the tape by $334 billion in passive volume generated by the Russell Index half-year reconstitution. With the removal of the Federal Reserve's forward guidance, the strategy of blindly chasing high-beta tech faces its first real structural test. This policy vacuum is forcing an institutional pivot toward defensive risk metrics and companies with established structural monopolies. This bar chart shows the performance divergence across the major indices during that week. While the Dow and the Russell 2000 held steady or rose slightly, the tech-heavy Nasdaq absorbed a 4.60% drop. Overlaying the macro fear indicators onto this chart, you can see the VIX spiking 9.71%. Alongside it, the US dollar index strengthened to 101.37. When volatility and the dollar rise together, it suggests an organized institutional flight into cash. We see this playing out in the commodity markets. Despite military escalation in the Strait of Hormuz, WTI crude fell nearly 5%. Global capital is currently pricing in the risk of macro demand destruction, which appears to be outweighing immediate concerns over supply-side shocks. This de-risking extended to Bitcoin, which dropped over 6%, confirming that the highest-risk liquidity assets were the first to shed capital. The movement of these capital flows suggests that institutional risk models are now prioritizing the possibility of a global recession over traditional geopolitical playbooks. Stripping away $334 billion in Russell rebalancing volume reveals where smart money actually moved. Institutions use that massive passive liquidity to execute a sell-the-fact strategy in tech, resulting in double-digit crashes for SanDisk and Applied Materials. While tech was being sold, the healthcare sector rose over 3%. AbbVie alone saw $13.3 billion in volume, ending the week up 4.20%. This suggests capital is not leaving the market, but is instead rotating into defensive yields. We also saw micro-dislocations in corporate pricing. Despite SpaceX holding over $100 billion in cash, its stock fell as valuation fatigue began to override balance sheet strength. On Thursday, Apple was forced to announce retail price hikes to offset rising memory component costs. The market responded by dropping the stock 6.12% on $30 billion of volume, showing how sensitive the market has become to downstream margin compression. The data suggests a tactical shift away from AI hardware growth projections and toward real-world defensive moats with tangible, cycle-resistant yield. 3 underlying drivers caused this repricing, beginning at the Federal Reserve. Chairman Kevin Warsh abolished forward guidance, completely removing the predictive communication model Wall Street has relied upon for 14 years. Without that guidance, the market had to digest a 4.2% CPI print without clear policy paths. This forces a contraction in valuation multiples, as long-duration equities price in a higher term premium, the cost of holding debt over a longer period. Next is the friction in global trade. The White House threat of a 100% retaliatory digital tax on the EU, combined with stalled trade negotiations in Canada, it signals that cross-border friction is becoming a direct headwind for industrial profits. AI compute classification has shifted from a commercial utility to a core national security resource. This is evidenced by NVIDIA's deployment of 35 supercomputers across Europe for a sovereign AI initiative. Because of this intense strategic importance, upstream hardware monopolies are utilizing multi-year strategic customer agreements to effectively extract higher margins.
This is systematically putting pressure on the downstream tech companies that rely on that hardware. This combination of a Fed policy vacuum, geopolitical fragmentation, and upstream AI monopolies signals a structural breakdown in valuation models for downstream tech giants. Tracking these drivers across the week shows the cascading effect on institutional positioning. On Tuesday, June 23rd, the end of forward guidance triggered an immediate tech deleveraging, dropping the Nasdaq 2.21% and crashing Micron over 13%. On Wednesday, Micron reported $41.46 billion in revenue, a 345% increase. Their massive strategic customer agreements proved the absolute pricing power of upstream hardware, briefly triggering a rally in AI-related names. But on Thursday, the cost of that hardware hit the downstream. Apple's forced retail price hikes led to a 6% collapse on $30 billion in volume. It was the first concrete sign that upstream costs were actively consuming downstream profits. This culminated on Friday. The culmination of the Russell rebalancing, EU tax threats, and military friction in the Middle East resulted in $334 billion of volume as institutions moved into healthcare. This 96-hour window serves as a case study for how policy shocks and cost inflation can rapidly force an institutional retreat into defensive positions. Looking ahead, institutional analysts are focused on three metrics: the structure of the VIX, EU tariff responses, and if the 10-year yield breaks above 4.45%. This diagram outlines the scenarios currently being priced. The bull case requires moderating inflation data and the VIX falling under 16. This would likely trigger a short squeeze on mega-cap tech, pushing the Nasdaq toward 26,200. The highest probability outcome is the base case. The VIX holds a range between 17 and 19, and the broader market moves sideways as capital continues to rotate out of chips and into utilities and healthcare.
The bear case is triggered if the 10-year yield breaks 4.50%, alongside a real supply shock in the Strait of Hormuz. This could result in a broader washout of passive ETFs, potentially dragging the Nasdaq to 24,100. Institutional capital is currently pricing in the continued rotation of the base case, making precise asset selection rather than broad index exposure the primary focus for risk management. In this environment, capital is seeking out companies with structural monopolies and established dividend moats. Our first setup is AbbVie, with a $444 billion market cap and $20.8 billion in free cash flow. Its pharmaceutical revenue is largely insulated from the current trade frictions and interest rate uncertainty. This technical chart shows an optimal entry zone between $245 and $253, utilizing the 50-day moving average as support. The stop loss is set at $218, below the 200-day moving average, with a target of $285. Setup 2 is Microsoft. This represents a play on the core infrastructure of B2B computing, which is currently trading at a 33% discount from its recent high. This chart maps the 33% drop from Microsoft's peak. The tactical entry is $372.97. We set a stop loss at $345 to account for potential tariff escalation, with a mean reversion target of $425. Finally, we have Micron. Following Friday's high-volume liquidity exit, the tactical entry is $1,132.33. This play is based on the continued scarcity of high-bandwidth memory for AI infrastructure. The stop loss is $950, with a target of $1,350. These assets, a healthcare giant, a foundational software monopoly, and an upstream hardware leader, represent a mathematically grounded approach to navigating the current policy vacuum. Thanks for watching Insight Engine. If you found this breakdown valuable, like the video and subscribe to the channel for more institutional-grade market analysis.